Hey guys, welcome to the village. My name is Bonnie. I create content around careers, education with a dose of reality check. Today we have a special video with an investment specialist, Yvonne Freely. That's a social media name. Okay, she is going to be talking to us about the two-pot investment system. Are we meant to be worried about something? Is the government trying to pull some tricks on us? That's what we are talking about today. She will also talk to us about her career in investment management. What's the difference between investment management and investment banking? She holds a BCom honors in financial analysis and portfolio management from the University of Cape Town. She's an NBA candidate and an CFA candidate. Okay, let's welcome Yvonne to the village.
Hi, Yvonne. Welcome to the village.
Thank you so much for having me, Bonnie. I'm so excited and I feel so honored to be here.
Let's get straight to it. We've been seeing this everywhere. I think from last year already, this two-pot system, which will take effect on the 1st of September 2024, which is in about 2 weeks' time now. Can you tell us briefly what is it? And why are people panicking, you know? Because I see there's a lot of panic online. So can you explain to us what is it and why are people panicking?
Right. Thank you so much, Bonnie. So the two-pot retirement system is actually a retirement reform. So it's law. So it's not an optional system that you can opt in. And it's designed to allow people that contribute towards retirement via retirement contributions, or if your company is contributing towards your retirement, to be able to access a portion of your funds while you're still working. But also to almost force us or help us save more for retirement. And it was designed to solve an issue that was happening in the industry. One, you'd see people leaving their jobs to access their retirement savings, right? So you're resigning, and then you're unemployed for a certain period of time, and then you then go back to look for another job. Now you don't have to do that because you have a savings component that you will be allowed to have access to even if you're still working. Then the other issue that the government is trying to address is retirement savings, so low retirement savings. As you know, only 6% of South Africans will be able to retire comfortably. And so government is trying to make sure that more, like they want to increase that percentage so that when you get to retirement, you're not old and broke. No one wants to be old and broke. So that's what this reform is about. On one end, to give us access to emergency funding in the event that something happens in our lives without us having to leave our jobs. And on the other end, to help us save more for retirement. And to answer your question around why people are panicking, I don't think it's really panicking, Bonnie. I think people wanted to access more of their retirement savings. I think people are not well informed of what the system actually is and how it is structured and how it's actually designed for them. And people aren't really understanding. People really care about how much is going to come into their bank accounts. And the mayhem is around, I don't know how much I'm going to be able to access. I don't know how much tax I'm going to be charged. I don't know what the government is trying to do. But hopefully this video helps them, or at least my response helps them understand that it's actually for them. You get savings that you can access whenever you want, once a year, and then you get an opportunity to also save, to not end up old and broke and depending on government grants.
Okay, Yvonne. So how I'm understanding this is for us, okay? This is not something that maybe government is trying to trick us to doing something that we don't want to do. Okay, so but the panic is people want to understand how much percentage. Is there a percentage? Maybe that should be my question. Is there a percentage that, okay, Bonnie, you can access 30% of your pension, and also out of that 30%, this is how much you will be taxed?
Right. Okay. Thank you, Bonnie. That's a great question. So What's going to happen is if you were contributing to retirement before the 1st of September, you're actually going to have three pots, right?
Okay.
You're going to have your old funds in what is called a vested pot,
Mm-hmm.
where all your old funds are going to be housed, right? And then you're going to have two new pots. So these are shiny pots, they have nothing in them. But after the 1st of September, from your old funds, there's going to be a maximum 30,000 Rand transfer. I say maximum because the actual percentage of the funds in your invested pot that's going to be transferred is 10%. So, for example, if you've only saved 20,000 Rand by the 1st of September, your 10% is 2,000 Rand. So 2,000 Rand is going to be put into your savings pot. If you have saved a million Rand to date, you have a million Rand in your vested or your old funds, you have a million. Even though your 10% is 100,000 Rand, you're only going to be able to access the transfer, the maximum transfer is only going to be 30,000 Rand. So that's the cap, which has made people very, upset, because if my 10% is 100,000, why can't I get 100,000? If my 10% is 50,000, why can't I get 50,000? So that's the issue that people are struggling with. And the reason for that cap, is to ensure that we save more for retirement. Your vested pot is always going to be there, so it's not going anywhere, and it's going to continue growing, so earning compounded returns, but also bringing in income in that pot. So it's not going anywhere, it's just old funds that are sitting there. And in the event that you lose your job or you need access to those funds, you're going to be able to access those funds. So it's not like they're going anywhere. The government is not taking away the funds that you've made, that you've saved already. It's just sitting in a separate pot that you cannot continue adding to, because you're going to be adding to the other two pots, the new shiny pots. I don't know if that helps.
Wait. So the old pots, let's say I want us to work with 1 million, okay? So first of all,
Yes.
government is saying I can only access 30,000 rands out of my 1 million. I know this is not an average, but I just think when we work with 1 million, it makes more sense. I don't want us to work with 700,000, So, okay.
Yeah.
Why is the government capping it? I think this is where, Yvonne, just agree with me. I don't know if you agree. This is what is upsetting people. So if 10% is 100,000, why do you care if I want my 100,000 or if I want 30,000? It just feels like the government wants to control how people use their money.
No, actually. So, like I said, the system is actually meant for us.
Right.
And your funds are not going to go anywhere. So the rest of the funds, the vested funds, are not going anywhere. What they're trying to do is help us save more for retirement, right? And that I want that to be very clear. They're not trying to control your money. They're just saying, as an initial seed capital, we're going to put in 30K at a maximum. If we put 100K, that's great, but we reduce the amount that you're going to have for retirement, which defeats the purpose of trying to encourage people to retire, to save more towards retirement. So 30,000 seems like a healthy cap, a healthy average across, all our funds, right? So
But
it seems
Yvonne,
fair. And
sorry, Yvonne,
yeah.
I'm not trying to cut you there, but what can I do with 30,000 rands? Like, let's just say I'm in debt. Maybe I want to pay off my bond, or maybe I want to pay off my car. Like, guys, please let us know in the comment section what you think. What if I have debts? Because, guys, typically your debts are over 100,000. They're not going to be some minor, like small debts. So is the government now saying you can't use your pension fund to clear your debts? I think that's what I'm gathering from here. You can't use it to clear your debts, basically.
You can look at it that way. I'm actually going to say something that actually be most upsetting to you, Moni, right now, and you're very So you're not going to get the full 30,000 in your account. For some, it could go down to 16,000, depending on the tax bracket that you're in, and also the fund fees that are going to be charged to your withdrawal. So it's actually going to be less than that. So say you get 18,000 after you withdraw, you are, you can use that for an emergency. And I understand what you're saying, that, what am I going to do with 30,000 withdrawal that will come in much lower? Maybe it will come in at 18,000. If it comes in at 18,000, what debt am I going to pay? And that's a fair question, right? But it's not, I don't think paying down debt is an emergency, Bonnie.
Right.
I don't think it's not an emergency. We take on debt because we believe that we're going to service it over the period that it's supposed to be serviced. That's not an emergency. An emergency, Bonnie, would be a member of your family has had to go under, a very expensive medical
Yes.
procedure,
Procedure.
and in your own savings and the medical aid, they won't be able to cover the full cost, right? And so you need access to a little bit more for you to be able to cover that amount, or whatever the difference. An emergency is not travel. Travel is not an emergency unless you're traveling to, I don't know, a family responsibility that you absolutely have to. But if it's traveling to Europe and leisure, that's not an emergency.
Interesting. Yvonne, you know what?
So,
What you are saying now is not a typical South African. Let's be honest, guys, and I'm sure you'll agree with me. Village will agree with me. Most people, there could be a lot of things. Maybe I didn't make a good example about a bond, or about a car. There could be a lot of debts, you know how it is, and then people, they just want to take their money and service their debt, So honestly, I just don't think this 15,000 or 16,000 will make any difference for a lot of people,
So I just wanted to say that I'm in no position to know what people's emergencies are, right? Maybe paying off debt is an emergency to you, and you found yourself in a situation where you actually can't afford to meet your obligations, and this once-off withdrawal could actually help you, relieve some of the pressure that we're experiencing. Inflation is very high, interest rates are at an all-time high. Things are so expensive these days. So it makes sense that people would want to withdraw to pay down debt to reduce some of that pressure. So if that's something that you want to do, I think it's important to understand that doing so comes with really hefty tax implications, which means that the 30,000, if you get 30,000, or even if you get 10,000, is not going to be 10,000 once the tax has been removed, because we're not being taxed at the retirement tables, using the retirement table. We're being taxed at our personal income tax rates, which is very high, right? So it's between 80 and 45%. So it's not, unless it's an emergency, a real emergency. What is actually advised from a personal finance perspective and just retirement savings perspective is to keep your funds locked in until you really need them. Because remember, they're still going to grow. So after the first initial capital, they're going to keep growing by a third of all your future contributions. So for instance, say a year from now, something really big happens, you can actually withdraw a higher, instead of just withdrawing the 30,000, you can withdraw a higher amount to cover that emergency that's going to come up.
Okay, sorry, Yvonne, I just want to understand something clear. Okay, at the moment, there is this 30,000 cap, okay? But let's just say we are all happy, we agree, we get into this, we agree, we start, right? But at a later stage, you can withdraw a higher amount if you need to. Is that what you are saying? If maybe you say, I want 200,000 from my pension, but from which pot now? From which pot?
Right.
This pot.
Okay, so yes, so remember the three pots: the vested pot, old funds, the savings pot, you can access once a tax year, and the tax year is 1 March to 28th February. So effectively, you can withdraw twice a year if you really think about it. And then you have the retirement pot, which you can never access, right? You can only access until retirement. So it's this retirement savings pot that I'm referring to for emergencies, and it does not have a withdrawal limit. So if you're like myself and you have a retirement annuity, my vested pot is not going to be accessible until retirement, right? And so I only have my savings pot. My intention is to actually leave the savings pot to grow, because if your savings pot, depending on how much you're contributing, if your savings pot grows to 500,000 in the next 5 years or in the next 10 years, or even $1 million, if it grows to 1 million in your savings pot, you can withdraw the full 1 million. No questions asked. So,
but Yvonne, the trick here, don't trick us, guys. So this savings pot is the one where you say people can have access to their money, but this savings pot is new. There's not going to be any money there in the next 5 years, Yvonne. Let's be honest.
Well, say for instance, Bonnie, you are contributing 5,000 Rand towards your savings. Actually, let me use a simple example. 5,000 Rand towards your savings pot, and your company matches contribution. So you're contributing 6,000 Rand, right? In your savings pot, say the maximum you're going to get is 30K. At the end of September, 2,000 Rand of that 6,000 total contribution between you and your employer is going to be transferred to your savings pot. All of a sudden, you have 32K that you can withdraw. After a year, you have an additional 24,000, which means that your total savings pot balance is 54,000. A few years from now, if you keep adding 24,000, that's going to be an amount of money that you can withdraw. So that's what I'm saying. It starts from zero, yes, right? Effectively, these are two shiny pots, but one pot is getting assistance by the one source seeding capital of a maximum of 30K, but it's going to keep growing. And if it grows to 400,000 in 5 years' time, you can withdraw the full 400,000 and maybe put a down payment on an investment property, right? Or, or that you're looking to do, that you feel is necessary at that time. So I know it sounds like, it's a smokes and mirrors. It's really not. It's very clear. We want you to have access to a lump sum of funds in the event of an emergency or a big life event, right? And we also want you to be able to save more towards retirement. The game is around saving more towards retirement.
Okay. You can leave any questions for Yvonne, right? But we still have some that are coming from you directly from the village. So someone left, we have terminated contract with a fund administrator, awaiting FSCA to finalize transfer to new pension fund. Can we be able to partake in the two-pot savings withdrawal with the old administration?
Right. Thank you. That's a good question. So because the contract, so depending on whether the contract has been fully terminated, I would need to know if it's completely done and we have migrated or we're waiting to migrate to another fund administrator. But assuming that you're in between fund administrators, you're still with the old one and you're waiting to move to the new one. You're waiting for approval to move to the new one. If you're in that situation, then the two pots are going to, the three pots, if you've been contributing, are going to be set up automatically, right? With the existing fund administrator, or pending the approval from the FSCA, the pots will then be set up for your company in the new fund. So that approval process is really critical to determine which fund is actually going to hold your three pots.
I think it's not finalized because he is saying awaiting FSCA to finalize. So I think they are still in the process, It hasn't been finalized.
Yeah. So I think they would be set up and then a transfer of all their funds a transfer will then be done to the new fund administrator.
Oh, okay. So question 2, in case of having both a pension fund and provident fund, how will the two-pot system work?
Right. Great question. So the two-pot system affects a fund. So each fund, which means that if you have 2 or even if you have 4 retirement savings accounts, all 4 of them are going to have their own pots. So it is affected at a fund level. So your 3K maximum is not across all your retirement fund accounts. It's actually across, it's actually each fund that you have.
Third question, is it worth it to withdraw from these pots or should just take this as non-existing thing? I think you've answered this, but you can answer it again. Because they are thinking, should I withdraw or should I just leave it?
To be honest, I think unless you have a real emergency, you should just leave your savings pot to grow. I said that before because of the tax implications and the impacts that it has on your future retirement lump sum, right? So let me clarify what I mean by that. So whatever is in your savings pot, right? Or whatever's in your savings pot is the amount that you're going to be able to withdraw as a cash withdrawal. If by retirement there's 0 savings pot, you're not going to get a cash lump sum. Recall if you have 3 million in your retirement fund, right? For retirement savings, and 2 million is sitting in your retirement pot, and 1 million is in your savings pot. So you say you've left it to grow to 1 million. The 2 million in your retirement pot has to buy an annuity that will pay you out as though you're getting a salary on a monthly basis. This is how we usually understand retirement, right? That you're going to be paid on a monthly basis. But there's a component that is not talked about a lot, which is the amount that you can actually just withdraw and use to set yourself up for retirement. If you withdraw all the funds in your savings pot, you're not going to have that cash component. It's not going to be available to you. Worse if you exhaust your vested pot as well. So if your vested pot is 0, your savings pot is 0, there's not going to be a cash component for you at retirement. You're only going to have the retirement annuity where you're going to be paid a monthly salary.
Okay, next question, Yvonne. Is it mandatory to withdraw from the pension fund? Can you opt out not to withdraw? I think you've answered this. It's not.
Yeah, it's not mandatory for you to withdraw. You withdraw when you want to, once a tax year, and you can't opt out of the two-pot system because it's law. So you can't say, actually, I want my pots to stay to be 1 pot, but others can get 2 pots. It's mandatory for everyone, but you don't to withdraw.
Okay, yeah. Will the two-pot system only apply to pension fund or RAs also form part of it? Yeah, I think everyone. It's not just the pension fund, but Yvonne can respond to that.
Yes, it affects everyone. As long as you're contributing to retirement, it affects you.
Can people who are already on a pension fund benefit from the two-pot system as in access more money from their pension as a lump sum when they're already on pension? I don't know if that question is clear.
Right. So this is for paid up pension contributions. And the question is around, do pensioners get 2 pots as well? So what pensioners will get is 2 pots. So a vested pot, which I think they've already accessed, savings pot, right? They won't get the retirement pot because there are no new contributions that you're going to make when you're already retired. So there's just going to
Yeah.
be the vested pot. Then they will get a savings pot set up for them, right? I want to clarify that if you were 55 years old and you're already in retirement, if you're 55 years old after the 1st of March 2021, then this is something that you can opt out of because you're already in retirement. Like you can literally say, I don't even want the two because I already my retirement funds have already vested. So I don't want this. But if you set it up, you actually have to tell your fund that this is something that I want, but it wouldn't be necessary if you're a pensioner. In my opinion, I would not best for these two pots to be set up if you're a pensioner.
Okay. Guys, most of your questions are similar, or Yvonne has already spoken about it, you know. So don't say how I left the question, but you didn't read out my question. I think in most cases, like in most of these questions have already been answered. But let me just go to this one. Does the two-pot system stop me from retiring early? From early retirement? Say I want to retire at 55, not 60 or 65 for men.
Great question. No, it does not stop you from doing that. It's just the retirement reform. So you are allowed to retire whenever you want. Even if you decide that you want to retire earlier than that, you can retire. It's just that you're still going to have those three pots. Not optional.
Okay, no, I get it. Guys, as I've mentioned earlier when I was doing my introduction, that Yvonne is a professional, okay? So I wanted to come back and speak to us about her career path because I know a lot of you are interested in this career path. So she will be coming back and let us know if I know you want it, but you can also just let us know in the comment section if you would like Yvonne to come back and speak to us about her career path because some of us, I'm one of those people, I confused her career path with investment banking. I don't know if you can just touch on that a bit, like how is what you are doing different from investment banking? And then we have our part 2 where we are putting you on the spot and we are sharing all the tea about your career.
Right. Thanks, Bonnie. Yes, that is a common misconception. So investment management, which is what I do, is we manage pension funds or large amounts of money, so millions of dollars, on behalf of institutions and high net worth individuals to invest in companies. So the field that I'm in is private equity. So we invest in profitable companies that have potential to grow. We invest in those companies and help those companies to essentially build their business to a place where we can then sell them or exit from that investment at a higher valuation. And the valuation is determined, there's so many factors that drive that, but increased revenue, increased profitability, etc. So my job is to firstly invest in the companies, one, and then the second component is grow those companies. And then the third component is to then help with exiting those investments so that we can get a profit for our institutional clients. And then, Bonnie, on the other side is investment banking, which is advising large organizations. So, usually listed companies or even unlisted companies. So, advising them on capital raising strategies, right? Which is very different from investing institutional funds in, unlisted companies. So, I'm happy to talk about that in a more detailed video and also give background to how this career path of mine evolved and help your village.
Because most of us, we think if you did economics, it means you must be an economist. We are not aware.
So my undergrad is actually BCom Economics and Finance, and I'm not an economist. I've never been an economist.
Okay,
No,
okay.
it's so
Um,
fun.
Yvonne, you know, this is not about the career questions, but there is one question that was sent by a villager before you go. We need to go through this question. Is it possible to enter the industry, specifically private equity, without one holding a CFA designation, but they have a strong finance academic background? What are the tips for someone who wants to enter the industry? Okay, e.g., what they need to look out for.
Okay, thank you, Bonnie. So just straight to the point, CFA. So CFA stands for Chartered Financial Analyst. That's a designation. So similar to CA SA, where you get a designated charter. So you have chartered accountants and then chartered financial analysts. You do not need to be a CFA for you to get into the investment management industry. You do need a finance background of some sort, but to be honest, it's literally BCom finance, BCom economics and finance, BCom investment management, and we can talk about that more in a separate video. But in terms of having the CFA designation, no. In terms of tips and tricks, I think where I would start is you need to understand company financials, because that's what we are doing half the time, right? Analyzing businesses from a financial perspective and understanding the value drivers, revenue drivers, how how best to create value for those businesses. So you really, in terms of tips, you really need to know how to analyze businesses, whether they're listed businesses or private businesses. And how I started my career on the listed side. So I was analyzing listed companies, but the techniques or the skills that are required are the same. Just really understand how to analyze businesses. So I know you're already doing it. If you're you're already doing it. If you're trying to pivot, maybe do a course. Free courses. You can do one on GetSmarter, just to confidently analyze businesses and give recommendations on what the fund you're working for or the company you're going to be working for.
Last question, Laga 2POS system. A villager sent me a document. I had to screenshot it. Okay, so can you analyze it for us, Yvonne? They said they don't understand what is written here. I'm going to have this on the screen for you guys, so that when Yvonne is going through it, you're going to see what we are talking about as well.
Right. So thanks, Bonnie. So the villager that sent the screenshot basically sent a table that they received from their fund, explaining exactly how the two-part system was going to affect them. And I think the part that they wanted to understand most is the loss of years. So the number of years that they would lose, number of pensionable service that they would lose. So I'm just going to go through the table. And the table is basically, all the examples are similar. So I'll just do one example. So the first example gives you the fund value. So the fund basically gave an example to say you have 95,447 in your retirement savings by the 31st of August 2024. The seeding amount that's going to be in your savings pot, that's going to be transferred to your savings pot, is going to be 10% of that. And 10% of that for this person is 9,544, right? Similar, so for example 3 says if you have 700,000 of retirement savings by the 31st of August 2024, the seeding amount is going to be capped at 30,000. So instead of getting 70,000, which would be the 10% of your 700,000, you're actually just going to get 30,000. So that's what the first two columns are talking about. They're basically telling you the ending value at 31 August 2024 and what is going to be used to calculate how much is going to be transferred into your savings pot. Right? Then column 3. right? Here, I'm assuming the fund was already giving or had already assessed what tax bracket this individual is in. But like I was saying, your bracket could be anything between 18% and 45%, depending on how much you earn. If you earn more than 1.8 or so million, you're in the 45% bracket. So let's assume that 31% is the bracket that they're in. They then go ahead and calculate how much is going to be removed as tax, that 31%, if they decide to withdraw the 9,544. They do the same in the example of the 700,000 by saying if you withdraw the 30,000 that were put in your savings pot, we will remove 9,300 as tax from your savings from your withdrawal. Right. The next part to help them understand the total cost of withdrawal is that they give a flat administration cost of 250 Rand, which means that the total cost of withdrawal is going to be the tax, which is in column 4, plus the administration fee, which is in column 5. And then in column C, then give the person who sent this an estimation of how much they can expect to receive in their bank accounts. So the money that you will receive if you withdraw your 9,544 is 6,335 based on all these assumptions. And then for the person who has 700,000 and has decided that they want to withdraw the full 30,000, they are only going to get out 20,450. Bonnie, remember what I was saying, that you're not going to get the full 30,000. Some of you are going to actually get 1,000 or less, depending on the fund administration cost, depending on the tax bracket, right? And then the last thing, which is the most important question, I think, because I think they wanted you to explain exactly how many years will be lost. So when it comes to years, right, when we're talking about pensionable service in terms of years, this only applies to defined benefit funds, right? Where the benefit that you're going to is already predetermined. It's almost like it's guaranteed. And an example would be the government fund, so GEPF. That's a defined benefit fund, which is very different from a defined contribution fund, which most of us have, right? So when we're talking about service, it's for defined benefit funds. And what happens here is if you withdraw money from your retirement savings, it essentially it's the impact is a reduction in your pensionable service, which is a factor that is used to calculate your retirement payout at the end, right? So in terms of actuarial assumptions, you have the final salary, you have the pensionable service as some of the factors that are used, right? So here, what the email that he got was saying to him is, if you withdraw this 9,544, the impact of your withdrawal is actually losing 6 years of pensionable service, right? Do I agree with the calculation? No. But that is not for this call. And quite honestly, I think we don't have enough information about the villager to determine how this 6 years was calculated. But just from a simplicity perspective, if you withdraw 10% of your retirement savings, the impact should be 10% of your pensionable service being removed from the number of years that you've served. Right? It just simply put. But obviously your fund will have to confirm this for you.
Okay. So
I
we
think
say they need to contact their fund manager. You know, they are the ones who must explain the last column, how they got into these 6 years, you know, because there are a lot of factors
so
that we are not aware of, the information that we are not aware of, because we don't know how they got there. And I honestly think that's the reason he sent this, because this is the column that was confusing him.
Yes, absolutely. So there's no way we can give him, even our opinion of what they're trying to say. So he has to go back to the fund. And I encourage all the viewers, like all the villagers, to actually go and find out what your fund is saying. If you have not heard from your fund in a very long time, reach out to them, find out what's going on and how this is going to impact you. It's really important for you to start engaging in this two-part system before it starts.
Yeah, even, you know what? We have a lot to talk about, but we need to get this video out as soon as possible so that people can benefit from it before the 1st of September. But before I let you go, I want to know, I know you have a YouTube channel, which I'm going to link somewhere here, guys. You're going to see her YouTube channel where she talks more on personal finance. But I don't know, do you offer any like consultations or, hey, Tina, we are too broke for you when you are managing like high end? Tell us about that. Is there something like that? And how can people reach you?
Yeah.
I can put everything in the description box, or now people can reach you if there is something like that.
Thanks, Bonnie. So how people can contact me is by engaging with me through the comment section on my YouTube channel. So I respond to all questions, even if they're not related to the actual video watching. So right now I have, about 30 videos that I've done on personal finance. So if any of those are that can help you, just put in a comment in the comment section and I'll respond. If it's a question, try not to put your name or your exact details. Like, don't tell me your salary if you can. Just tell me the situation and then I'll give you my opinion on your situation. But yeah, that's really the best way to get a hold of me. And in terms of, do I offer any advisory or any mentorship? Not at this time. So the best way to contact me is through my YouTube channel. And if you haven't already, go there. I know you're right here. And if you're not subscribed to Bonnie's channel, like, why are you watching this video?
Go subscribe to
You need
Yvonne's
to.
channel. She will give you more than I can give you. Like, because there's no point of talking about careers and salaries and stuff, but our personal finance is not on point, So go check out her channel. But if you have any questions, there are specific to this video, everyone will come back to this video and engage with you. And then we will record a career related video. I know a lot of people are looking forward to that one. Yvonne, thank you so much for your time. And yeah, we'll see you soon. You are going to be our friend.
Yes, I think I've made a lot of friends from your village. Thank you so much, Bonnie. I really appreciate this opportunity. And thank you so much to your tribe, your villagers. Hope to see you in the next video.
Okay, thank you.
Okay, guys, we've come to the end of this video. I hope you found a value. Please drop any questions that you might have for Yvonne. She will come back and engage with you. Yeah, and let us know if you like that video on her career path. Otherwise, I'll see you on the next one. Bye.